For the very first time since June of 2021, the Federal Reserve has made a change to the Reverse Repo Facility that should completely drain it once and for all. This is a chart of the Reverse Repo Facility at the Federal Reserve, and you can see starting in 2021, a bunch of cash started flooding into this facility until it topped out in 2022 around $2.3 trillion. So let me explain the way that the Federal Reserve caused all that cash to flood into there and the reason why they did it. Initially in 2020, when all of the money printing started, the Reverse Repo Facility was set at a 0% interest rate, just like the federal funds rate was. But a couple of unexpected things happened as a result of the monetary and fiscal policy. Number one, the Federal Reserve doesn't just print money and hand it out. They do something with it, which is purchase assets onto their balance sheet. The majority of those assets are treasuries that they buy from banks. So the Federal Reserve prints a bunch of cash, they buy treasuries from banks. Those banks can then turn around and loan that new cash directly back to the US government, creating new treasuries. What the US government then does with all that cash is it spends it in the form of stimulus checks, PPP loans, and other spending programs. As a result of this, the economy, the financial system, has two things that happen simultaneously. Number one, it gets flooded with the newly created cash. It went from the Fed to the banks to the government and then spent into people's bank accounts. So a lot of new cash hits the system. But the second thing that happens is the financial system itself has a lot fewer assets in order to offset that cash. If you want to know what I mean, consider this. When you put money in the bank, it is your asset because the bank owes you that money. But to the bank, it is now a liability because they owe you that money. Just as if you owe somebody else money, it's your liability. So they have to go do something with that cash in order to offset that liability, which is buy an asset. The problem is the Fed just spent the last couple of months buying up all the assets out of the financial system. The few assets that were left to be bought were being bought up at higher and higher prices. As these assets are debt, that means once you get over 100%, you start to tip the interest rate or the yield on that debt negative. Meaning if you have an IOU from the federal government that says the federal government will pay you back $100 and I pay you $101 for that, I'm still only going to get $100 from the government when they pay that back. But because I paid you $101 and I get $100 back, my interest rate is now negative. So to recap, the Federal Reserve created a bunch of money, bought treasuries from banks, so less assets in the system. The banks lent that money to the government spent that cash back into the economy. So now the financial system has a lot more cash and a lot fewer assets. The banks go looking for assets to buy in order to offset all these deposits, and there's not enough. So the Federal Reserve says, okay, we got to do something about this. We'll use the Reverse Repo Facility and allow that cash to be lent back to the Fed in exchange for temporary collateral. All the collateral that the Fed just bought up out of the system. In order to incentivize that cash to be placed into the Reverse Repo Facility in June of 2021, they increased the interest rate that was being paid on this cash to 5 basis points above the lower end of the Fed funds rate. So here is the chart of the federal funds rate. You can see all throughout 2020 and 2021, and even into 2022, the federal funds rate was held between 0 and 0.25%. However, during that time frame from June of 2021 all the way until February of 2022, the interest rate being paid out for cash held in the Reverse Repo Facility was 0.05%. In other words, if you are a bank, you get a bunch of deposits, it is free money. You take that cash, give it to the Federal Reserve temporarily, and you get paid 0.05%. In exchange for that, you get the collateral that you need to offset the liabilities. These are repurchase agreements that can be unwound at any time. And so it is just like reserves. They're able to unwind that if they need to meet deposits or withdrawals. This was obviously very lucrative for banks, which is why it sucked $2.3 trillion into the Reverse Repo Facility over the next few years. And the kicker here is that once the Federal Reserve started trying to fight inflation, they were raising interest rates. They had to keep that 0.05 difference so that they were paying a premium into the Reverse Repo Facility so that all that cash didn't just flood back out into the financial system, causing more stimulus. Now they're trying to fight inflation, making sure that stimulus doesn't go out into the economy. They don't want that cash out there being used for productive purposes. They want to keep that cash locked away in the Reverse Repo Facility where it can't be used. So they're literally paying banks hundreds of billions of dollars just to hoard that cash with the Fed overnight and not do anything productive with it. So let's look at these two charts Overlaid on top of each other, you can see the lower bound of the Fed funds rate and the reverse repo rate continue to stay in lockstep, with the reverse repo rate being just 5 basis points higher than the lower bound of the Fed funds rate all this entire time. And even recently, once the Federal Reserve began to lower rates again, it was still in lockstep. Let's zoom in here on the most recent action. You can see a little bit of separation between the lines. You can see that up until a few weeks ago, the lower bound of the federal funds rate was at 4.5%. However, the reverse repo rate was at 4.55%. So for years now, they wanted to make sure that cash stayed inside the reverse repo facility and didn't all flood out at once. But now you can see they have changed that policy. Both the reverse repo rate and the lower end of the federal funds rate are locked together at 4.25% now, which means there is no longer any incentive to keeping your cash in the reverse repo facility compared to alternatives. And yes, there's only $98 billion left in the reverse repo facility at this point. It is almost drained, but there's no longer any reason to keep excess cash in the reverse repo facility. Instead, that cash will be sucked out into the T-bill market, and you can see right now T-bill rates have been falling, and they will probably stop falling just right above that 4.25% mark. Because at the end of the day, there's still a little bit of extra risk with something like a T-bill versus going directly to the money printer itself, the Federal Reserve. So that tiny bit extra risk commands a tiny bit extra premium on the yield. So the question is, why now? Well, number one, it's because the reverse repo facility is almost entirely drained already, and so its impact on markets is going to be negligible. What's another 98 billion thrown into the T-bill market? Really nothing at all. But number two, it highlights the fact that the Federal Reserve is no longer concerned about withholding liquidity from the market. Yes, they are still trying to combat inflation, but they are battling the hurricane of inflation on one side with the earthquake of a deflationary death spiral and a government default on the other side. Which way do you think they're gonna lean? The Federal Reserve will always lean towards a little bit extra inflation. So they don't want to floor under interest rates anymore. They want to continue to be able to save face with their balance sheet and quantitative tightening and maybe slowing down on interest rate cuts. But in my opinion, they are changing direction a little bit too early. Inflation is still much too elevated, and many measures are showing inflation is actually turning around and heading higher, which means the Fed will probably have to pause rate cuts entirely here, may not cut at all next year, and could in fact even turn back around and start hiking again in a repeat of what happened during the 70s, starting cutting too early into inflation, having to change course and try and get back in front of inflation again, all in an effort to really try and help the government to not default, which we all know is a lost cause, especially if you are just counting it in terms of purchasing power. So at least for right now, it looks like the reverse repo saga has finally come to an end, as they have removed the premium to suck cash or keep cash inside that facility to allow the last little dregs of that liquidity to go back out into the T-bill market to help out the government with their finances just a tad bit more. As always, thank you so much for watching. Have a great day.